All right.
So,
Well, out of respect to the people who are punctual, maybe we should get this going. Yes, Dave?
Indeed. Oh, I couldn't agree more.
All right. All right. Well, let me just get a little bit more prepared. So, as always, thank you to you folks that are joining us tonight. Um, we don't have a New Hampshire primary to stay up and watch, so this is probably a good time slot. And again, as always, we should keep this succinct enough to leave adequate time for question and answers. And you'd be happy to know if you happen to be able to see the legend in the upper left-hand side of the screen. There's only 4 slides. So, and one of them's the cover. So we'll be able to keep this brief, but hopefully informative. So, the hallmark, in our view, the hallmark of the market in 2023, or at least one of them, is the amount of market and economic pundits who are just emphatically wrong about their 2023 projections. I mean, it was an incredible amount of disparate noise to throw at investors, whether they be lay investors or professional. Folks, very influential pundits talking about an absolute certain recession in 2023. No. The market revisiting the October lows in the S&P 500, October 2022, which was like a 15-20% drop, never happened. And on the flip side, people who are predicting the S&P to go to 5,000, not a chance. So, why would I be relitigating this now when we're here to talk about our forward look into 2024? Well, going into this year, there is no shortage of headwinds to be concerned about. And nobody be faulted to be worrying about the expanding conflict in the Middle East, or what will absolutely be a crazy town election cycle, or the huge increase in the U.S. debt service now that everybody's owning treasury bills at a higher interest rate. So you have this huge menu of things that you could be worried about. And I think 2023, beyond generating nice returns, was productive in part because of the returns, but also because so many pundits were wrong. And it just retrains us to remember that sometimes you have to set your own plan and follow that plan and not be distracted by extreme, projections by the financial media. So the 2024 market outlook, let's just get into the observation side of our presentation here. So the U.S. economy has been stronger than expected. I mean, just today, fortuitous timing, GDP, gross domestic product, came in at 3.3%, which was about double what a lot of folks were predicting. Unemployment is remarkably low. Wages are rising. What's not to like? So the economy is stronger than expected, but the consumer, which is 3/4 of GDP, is stretched. Credit card balances are high. You're starting to get some delinquencies in installment payments. So, the 3.3% GDP, which is phenomenal, is actually a little bit of a step down from the fourth quarter of last year. So it begs the question, is this as good as it's going to get in the near term? And it may be. Second point is the market is fully valued. I mean, virtually all assets, frankly, including real estate, are fully valued at this time. And as we've been saying lately, very little is cheap. There are not many asset classes that are inexpensive at this time. And that's a little bit unusual. A notable example in 2015, oil prices crashed. So energy stocks and related industries were just crushed, and the market was doing quite well at that time. But you had a 20 or 30% decline in energy, and people who rebalanced their portfolios in 2016 and put a fair amount of money in energy ended up generating a nice return because they found a cheap asset that they could exploit to their advantage. We don't really have that at this time. In of itself, acknowledging that the market is fully valued and not much is cheap is not a sell signal. It's just a recognition that now you have to be a little more selective, a little bit more value conscious, and we'll get into that. But we're going to illustrate this idea of the market being fully valued with a slide that comes from a quarterly market statistical book that JP Morgan puts out every quarter. So look at this upper right side or the right panel where I'm moving my cursor around. So you'll see, the most commonly held investment sector being large cap stocks, sort of a blend between value and growth stocks. The current PE ratio is 19.5. Over the 20-year average PE ratio of 15.6. So these large cap growth stocks that have been so central to performance over the last 12 months, they're trading 25% above their 20-year average. If you look at technology stocks that are in the large cap growth sector, they're trading at PEs of 26 with a 20-year average of 18.9. Mid and small cap stocks, which are much cheaper right now, and we'll get into that, they're closer to their long-term averages. So you take mid-cap blended stocks with PEs at 17, just gently above their 20-year average of 16.5. So really the large cap stocks are relatively overvalued. And then you could see below it, it expresses that same information. Whoops, this is where I get my hair trigger. You can see in the lower part of this right band, they express that just in a total percentage. So large cap growth stocks are trading about 25.2% above their 20-year average, whereas small cap value stocks are trading below their 20-year valuation average. So this is just a little statistical glimpse at the point we're making that not much is cheap at the moment. And that's, again, not a sell signal. It's not a scary thing. You just have to be a little more picky. The third observation about market conditions going into this year is that the market returns have been very concentrated. In fact, too concentrated. The top 10 stocks in the S&P 500 are responsible for a vast majority of the returns. And whenever the market narrows, it becomes a little less trustworthy in terms of risk-adjusted returns. But the good news, and what we're here to tell you today, which we'll get into on the adjustment side of the presentation, is this opens up opportunity for investors to diversify away from those concentrated equity positions and find value in lagging or cheaper assets. So just to demonstrate how concentrated these top 10, or you may or may not have heard this term, the Magnificent Seven, these 7 top tech stocks, how concentrated they've been. And we'll look at that briefly by using, again, another Morgan Stanley slide. On this slide, you can see here in the upper left that the top 10 stocks, which are all tech, maybe it has Eli Lilly in there, but Microsoft, Amazon, Meta, NVIDIA, Apple, of course, they are trading at 26.9% earnings. And here they are responsible for 86% of the S&P return last year. The remaining 490 stocks combined only responsible for a 14% return. That is a definitive, quintessential example of concentration. Here is another good way to look at it. This is the weight of the top 10 stocks in the S&P 500 going all the way back to the beginning of the tech miracle, the Silicon Valley miracle. And you can see that right now the top 10 stocks represent 32% of the S&P 500. That's the highest since tech stocks came on the scene, and it's even higher than in 2008 when we had a tech bubble. So again, much of this is deserved. Just because tech stocks have become so concentrated and highly weighted is not all folly. There's so much innovation and growth going on that they deserve this premium space. But there comes to a point where it's so crowded and so overbought that when the party stops and you haven't diversified into some of the cheaper assets, then you start getting, a very poor risk-adjusted return, or at least a lot of volatility that is unwelcome to most investors. The global macro, global meaning all countries, macroeconomic growth, their growth rates now are tepid. So the US is clearly the strongest house in a slightly tepid neighborhood. And we have to be mindful of that in the way that we select global investments. We need to be, again, a little bit more focused on profitability and cash flow. So we'll get into that. The next two slides really reference the bond market. And because of a variety of events, the bond market has come back as a very productive tool in overall portfolio construction. And we haven't had that privilege for like 7, 8, 9 years. So we're going to talk about that. But the first observation about bonds and interest rates is the fact that we do have still, even more so, an inverted yield curve. And an inverted yield curve suggests a slowing economy ahead. It doesn't mean it's going to crash, just means that it's slowing, or at least it indicates that it would. Historically, in a vibrant economy, you have an upward sloping yield curve, which simply means that you get paid a higher interest rate as you invest in longer dated bonds. So the further out you go, the higher yield you get, as an acknowledgement that the economy will grow over time. So if you get an inverted yield curve, you see higher interest rates for short-term investments and lower interest rates as you go further out. And that typically is a harbinger of a slower economy. So I'm going to show you that yield curve and ask Ryan Breen, one of our advisors who's an expert in fixed income, to explain what this inverted yield curve is and what it means for bond investments. So just give me a second to get to that. Ryan, what slide is it again?
34.
Okay. Lots of data. Here we go.
There you go. Yeah, so this is the U.S. Treasury yield curve, right? So it's showing the various um, rates of yield based on the date of maturity on the bottom axis there. Um, I think that there's a few things that this slide points out um, that are important. One is kind of the most obvious to me, and when I look at it, is that these more recent dates, the blue line being December 31st, 2023, and the green being the end of 2022, those being substantially higher than where we were at in 21 and even in 2020 and 2019 and younger. We are towards the higher range of a 15-year range there, which is the gray area. So it's we're not at that quite top, but it is very productive as far as just clipping the coupon of owning bonds and getting a nice healthy yield while holding that. The inversion, as Charlie mentioned, it does seem a little more exaggerated for the end of 23, as you can see the short dated 3-month yield being all the way up in the fives. That is, as we all know, that's kind of where the Fed stopped just about when they ended their rate hiking cycle. Now we are seeing the longer end, more so even today than at the end of last year, starting to hike up a little bit. And currently the 30-year is closer to 4.3 right now, as is the 20-year. So that is showing that we're getting back to closer to a normal yield curve potentially. When we have the rate cuts, whenever that happens, then that will kind of move that along. But yeah, point being that rates are still high, and fixed income does have a meaningful place in investment portfolios.
Right. So our goal, and you'll see this in the next part of the presentation, is to lock into these higher rates before they begin to fall. But so the last thing that we'll say about the observational side of this presentation is that really the Federal Reserve is the wild card here. I mean, when you get a good GDP report in January and corporate earnings are coming in pretty well, the market could support itself. But if we start to see a softer economy, we will need an interest rate cut to keep the returns high this year. And while that sounds like a little bit of a roulette scenario, we believe that the Federal Reserve will cut interest rates at least once, if not twice, to prevent a deep or at least shallow recession. And that'll be very supportive of stocks and bonds. So it is a wild card because clearly no one can truly predict it. But it's very possible that healthy portfolio returns in 2024 will require an interest rate cut from the Fed. And I think we're going to get that. That's our view. One of the interesting anecdotal evidences of the economy getting softer is you're starting to get a lot of announced layoffs right now. And a lot of companies, mostly tech related, are laying off employees just to keep their profit margins higher. But, we don't think it's going to become a chronic issue. But, all right, so let's move from the observation comments to the adjustments comments, as I like to call it. So adjustments, AKA, what are we doing about it? What are we recommending to our clients? Number one, with the equity exposure that you have, if you're in a 60-40, 70-30 model, whatever it is, we want to be moving, if you're not already there, a portion of your equity exposure to money managers or strategies that focus on profitability and free cash flow. That's first and foremost. Now, you might say, well, isn't that how you always do it? I mean, if you're an investor, are you always not focused on profitability and free cash flow? Or aren't you always focused on these attributes? And generally, the answer is yes, but a lot of index funds that people are invested in are just chock full of companies that are really going backward at any given time. Right now, if you're in an index fund or a well-known big behemoth blue chip fund at Vanguard, you probably own 3M, which is seeing negative earnings, negative cash flow, Boeing for recent example, and a generic blue chip fund would hold these kind of things. There are many criteria on which money managers predicate their strategy. A lot of them have to do with growth rates, year-over-year growth rates, whether companies are profitable or not. But there are also money managers who are famous and have amazing track records by making their selections specifically on profitability and free cash flow as the top two metrics. And they end up having phenomenal risk-adjusted returns over 3, 5, and 10-year periods. And you end up with a portfolio of companies that have that in common, whether they're in tech, energy, industrial, healthcare. They don't care. They're agnostic to the industry. They just want to make sure that the investments are profitable and have great cash flow. So I'm going to ask Steve, who's our research person, to define profitability and free cash flow a little bit better.
Well, profitability seems to be one of those things that should be very straightforward. And I'm not going to get into a lot of details, but it also tends to be something that can be managed. The free cash flow yield portion is the metric that would tell you that a company has a robust business plan that's efficient. And free cash flow yield is the free cash flow divided by the share price is essentially what it comes down to. And we're using baskets that use that free cash flow yield metric as their primary, I'm missing a word, sorry, their primary sort. And then they look at profitability, and we have some that look at economic moat, and we have some that would then take the top of that sort and market weight it, or weight it by market cap is a better way to say it. And that's the portfolio you end up with.
Right.
I don't know if I made that less
That was good. And
clear or more clear.
Yeah, it was. I found it clear. We can tackle that in the Q&A, but for our clients, we have already started moving towards these baskets that are predicated on these attributes that Steve just mentioned: profitability, free cash flow, and they have shown to have better downside protection while allowing you to stay in your seat and stay fully invested to get, the subsequent upside. So we're already making this move. It's not brand new to us, or it's not an epiphany we had yesterday. But, in a bull market where everybody's chasing AI and tech stocks and semiconductors and everything's going up like 2023, you don't need to be too worried about that. When things hit peak valuations and the economy starts to slow a tad, then all of a sudden these metrics become more important. in terms of getting a good risk-adjusted return. So that's number one adjustment. Number two, it's just a subset of that. We need to get cheaper. So when the market gets extended, you want to get cheaper. So, what does that mean? Cheaper in of itself never guarantees you're going to get a better return. It's just that cheaper allows you to get a good return with taking less units of risk. So it's a risk-adjusted issue. And, when we go back to that chart and we look at how extended these top 10 global or large cap tech stocks are, it allows us to find things that are so much cheaper. So this little list here itemizes the things that we believe are the most virtuous and are cheaper for 2024. So small cap stocks, definitely cheaper. The discount in performance between small cap stocks and large cap stocks right now is among the largest in market history. And given that small cap stocks are more moved by stimulus, whether that stimulus is lower tax rates, lower interest rates, we believe that an interest rate cut would be very much in favor of small cap, and they would play a lot of catch up. Industrial stocks, Siemens, for example, in Germany trades at like 16 times earnings, where most industrial stocks around the globe are in the 20s. So there are a lot of opportunities to find cheaper price points in industrial. International stocks are significantly cheaper than domestic. So we're looking there. Healthcare, the healthcare sector is not cheap so much as it is a lagging asset for a whole host of reasons, some of which we can't fully reconcile. While tech and other things were producing 20, 25, 30% returns last year and above, healthcare was kind of stuck in neutral. And, we think that it will also catch up as healthcare is rarely left out of bull markets. And then finally, real estate investment trusts, particularly with the income that they pay, are coming off of a bad patch with the impact of COVID and vacant offices. Real estate trusts, most of which are not in offices, but more dependable asset groups like public storage and cell towers and healthcare facilities. There's great value in real estate trusts for 2024. So small cap, industrial, international, healthcare, and real estate are places that we can look to try to diversify away from the Magnificent 10 and expect to get a competitive return. This is the valuation. So small cap stocks, certainly small cap value, trading at a 16.3 PE against a 20-year average of valuations of 16.7. So it's a little bit of a discount. And if interest rates are cut, that stimulus will affect small cap stocks significantly. And, I'll show you a chart a little bit later of another way to look at the potential for small cap. So here, the discount of the price to earnings ratio of US stocks to international, you hear right now, international stocks have a 33.9% discount to the valuations of US stocks. So the 20-year average for the S&P 500 up is 15.6, now trading at 19.5. The 20-year average PE of international equities is 13.1, now trading at 12.9. So that's a great valuation discount for international markets. Now it's complicated, different currencies, different economies. You can't just buy a generic international portfolio and expect that it's going to give you this great reward because it's cheap, but it's a great starting place to find comparable companies. SAP, the software company in Germany, versus Microsoft. Sanofi in France is a healthcare company versus Merck. I mean, there are all these opportunities to get great franchises at cheaper prices. Yeah, this is a table of asset class returns dating all the way back to, more than 2 decades ago, or close to 2 decades ago. The last time that we came off of a large tech overvaluation with lowering interest rates was after the 2008 financial crisis, and when the Federal Reserve became stimulative again, and investors were sort of staying away from the high valuation, large cap growth stocks that dominated the market before 2008. You could see years of outperformance by real estate trusts and small cap stocks. So 2016, you had small cap stocks up 21% versus the large cap group up 12. In 2011, when the economy started to recover, real estate trusts were up, 27% over these 2 years versus large cap stocks only up 18. So a stimulative lower interest rate environment coming off of a high valuation market often promotes better returns in REITs and small cap stocks. So again, I'll summarize it by saying looking for cheaper investments in of itself doesn't guarantee better returns. But for now, we feel we need to get cheaper, and this is a good starting point. So focus on cash flow and profitability, find cheaper assets. Number 3 is going to sound a little contradictory, and that is you still need to maintain a position in innovation. So innovation stocks are wonderful, whether it's therapeutics or AI or cloud computing or cyber, or even consumer staples like Chipotle or Costco. They're innovation in their own way. These stocks shoot to the moon and they get ahead of themselves. But if those innovative trends are intact and have length to them, for that sleeve of innovation, which could be 5% of your portfolio, 10 or 20, you do need to adopt kind of a bend but not break mentality. You want to acknowledge that sometimes they get ahead of themselves when everybody's chasing it. But if that innovation trend has 10 more years in it, you want to hold that innovation. And it's a great way to grow assets in a otherwise stagnant economy, because then that higher growth rate will stand out. So, what are innovation areas? Well, obviously, one of the most noted recently is AI, which happens to be a big area of interest for Ryan. So we're just going to give you a little sample of why we would consider AI to be an investable innovation area. So Ryan, why don't you take this slide?
Sure. Yeah. So I mean, this slide, as you can see, is shows the global AI market, a forecast of that market going into the future, and it's, as you can see, showing it growing to a market of 1.8 trillion by the year 2030. These growth rates, 44% or 34%, are based on the data that this Statista company has compiled. We don't know for sure that this is how it goes, but it is certain that from 21 to 22, annualizing that growth rate out, this is potentially where it could be. And yeah, it's clearly a focus of expenditure It's going to create, lots of production, add to GDP. I mean, I will just some general comments on technology as a whole and AI. A tech platform of any sort is disruptive, and it can lead to changes in market leadership. If you think about the past, you think about personal computing in the 90s, or the internet in the 2000s, or the cloud, or mobile devices like smartphones in the 2010s. Artificial intelligence is potentially the 2020 technology that will disrupt and change, and it certainly could redefine some of those market leaders that we've seen kind of change their ranking over the past years. This disruption does offer opportunity for investors, and it will certainly make some companies need to change, disrupt them in a way that they'll have to navigate it. So we keep our eye on that as best we can. But I think that the general message, as everyone knows, is that AI is here to stay, and it's an investable thing for your portfolios.
Right. So, yeah, I mean, Coke and Pepsi and Home Depot, if the economy slows and they're growing at 3 or 4%, then obviously you're going to want to keep your toe in the water for innovation stocks that might be growing 15 and 20, even if the price of admission to those stocks is a little bit more volatility, and you can just control the impact on your overall portfolio by dealing with the portion size. So we want to stick with innovation, even though we want to get cheaper as a whole. So the last two things are easy to talk about, and I probably won't use the slides just in the interest of time, but we want to increase the fixed income exposure for most clients. Why? Well, bonds right now are poised to offer both safety, risk reduction, and potential appreciation. So as interest rates come down, bond prices go up, and a 1% decrease in interest rates, let's say for investment grade corporate bonds, would lead to an appreciation, Ryan, of what? About 9 or 10% in the value of the bonds, in that range. And so if we feel, as we do, or given that we feel that interest rates are likely to come down, not demonstratively, but enough, if your bonds are paying 4-5% in dividend yield and the value of the bonds go up 4 or 5%, then you're looking at 8 to 10% returns in bond investments this year, with zero correlation to the stock market. And we feel it's very, very likely that bonds will have total returns in 2023 that are competitive with the stock market. I mean, we're not making any predictions right now about the stock market's return, but it would not be odd or unexpected to see equities do 7.5, 8%, which is what bonds could very well do, or more, at a much lower volatility level. Last year, this didn't happen because the spike in interest rates, or I should say in 2022, the spike in interest rates took away that safety premium of bonds. But now that interest rates are stable or going down, they will once again provide the ballast to your portfolio and some appreciation to produce returns that could rival the stock market. And lastly, it's going to be very important this year that we as an investment advisors are very opportunistic with your portfolios when we experience 5 to 10% corrections. There's not a lot wrong with this economic backdrop. Yes, investments are fully valued, but employment is great. Interest rates are within a normal historical range. GDP has been better than expected. The political, the election cycle will be crazy, but it shouldn't get in the way of the underlying economy. And so given that relatively stable backdrop, if anything causes the market to have an intra-year 5 to 10% correction, it would be important to put some money, some cash to work to take advantage of the bargains that are created, because it's likely that those corrections would be short-lived and you would want to use them to your advantage. 2022, maybe we weren't as likely to be proactive that way because it felt like the market was going down all year. Here, corrections will be buying opportunities. So just to summarize our adjustments and open it up to Q&A, we want to move or migrate money to money managers or strategies that highlight free cash flow and profitability. We want to try to find and diversify into assets that are cheaper, that have some catch-up opportunity or could be more defensive if things get jiggy. We don't want to leave our innovation investments. We might trim them, but we want to maintain the assets that we have in tech, medical devices, AI. We do want to counterbalance that with an increased exposure to fixed income, because we think the returns are just going to be competitive. And, you'll dual purpose your bonds for ballast and a solid return. And we're ready to be proactive to put money to work if there are corrections along the way, which there sure to be. So that's it for our prepared remarks. I went 7 minutes over my target, but shucks, we don't have political TV to watch tonight, so I'm good to go. Thank you all.
Appreciate it.
Great. I appreciate your time, and we look forward to what we're going to come up with February. We've hired a new advisor in training, junior advisor, this really smart young man out of Wesleyan, and he'll join us February 5th. And so maybe the next time we have a knowledge series, you'll see a better production level, because we'll get our new guy on making a better looking presentation. But all right, everybody have a good evening. And if you want to speak to us personally, just reach out to Dave. He'll schedule it.
Thanks,
Thank
everybody.
you very much. Thanks to
much.
all of you guys for the help.
Thanks, all of you. Good night.
Yeah. Thanks,
Good night.
Charlie. Thanks, Dave.